hope you're having a good time at the conference. For our last session today, we have Mr. Bhargav Dasgupta, MD and CEO of ICICI Lombard General Insurance Company Limited, the largest private sector general insurance company in India. Mr. Dasgupta began his career with the erstwhile ICICI Limited in 1992, and he's held key leadership positions in diverse business areas in the ICICI Group, including project finance, corporate banking, e-commerce and technology management, international banking, and life insurance. Mr. Dasgupta holds an MBA from IIM Bangalore and a BE Mechanical degree from Jadavpur University. He is currently the chairman of FICCI's Insurance and Pension Committee and is a member of IRDRA Insurance Advisory Committee. He'll be discussing the evolution of insurance industry and the roadmap to drive profitable growth for ICICI Lombard. The discussion will be held with Avinash, who leads our insurance desk, and then we'll have question and answers after that. So,
thank you, Bhargav. Thank you a lot for agreeing to attend our conference and to have this session. To start off with, I mean, particularly in the context of insurance and general insurance, that's the business of purely risk. You have three broad set of stakeholders. One, of course, your policyholders at the heart of everything. And then you have shareholders and your employee and distributors. And it's really, for an insurer, it's a tough task sort of balancing the interest of the three. I mean, because often more than not, you will be hearing one complaining about their sort of interest being ignored. So in your experience of over decades, how have you, I mean, sort of managed to balance the interest of three? And if compared to any sort of your other industry or your other experience, how difficult is it in insurance?
So thank you. Good afternoon, everyone. And Avinash, this is not a question that I expected to get in this conference. In a management, consultant meeting, maybe yes, this is a good question to ask. But let me kind of think about this. And you see, in any business, there are multiple stakeholders. In insurance, I think the incremental very important stakeholder from a financial service perspective is a distributor, because insurance is a product that is typically distributed through third-party entities. But let's step back and think about creating value in a business, right? So at the end of the day, if you want to create value, at the end of the day, you have to provide some value to customers. So at least the lens that we look at whenever we take a final decision, whenever all forces are aligned, there's no issue. Whenever there's a conflict, I think the final vote goes in favor of the customer. And at least our view is that's the only way to build a sustainable business. When you look at the employee, at the end of the day, you obviously have to invest in your employees, but as long as the employees' objective is aligned to the organization in terms of creating value for the customer, I don't see a problem. Now, coming back to your question about shareholders, obviously, at the end of the day, if you do not, have a franchise that you're building where there is some kind of a moat and you're building something of value over the period, your shareholders will not benefit. So now let's look at your three stakeholders. So there are situations where the insurance distributor may want to extract maximum value out of a transaction. That's true, that does happen. But if you study global insurance markets, while that may be the case, but even the distributor understands that if you want to build your business, build scale, it has to be reasonable in terms of what is it that you extract in terms of the value. What does happen in an immature market like in India, and I call it an immature market because while it's 22 years, I think the practices still are evolving. What does happen in immature markets is that there are companies which at times want to gain market share at the cost of the shareholder, and in those situations, the distributor benefits. Finally, whether the customer benefits or not, the distributor benefits. So it's a question of the market maturity. When people realize that if you want to create a franchise, if you want to create a business model which lasts, you have to think about how are you returning, you're providing enough returns to your shareholders. And India, we've seen many phases. We've seen the opening up in the initial days when it was a tariff market, things were much better. Then you saw a whole stream of companies coming in around the 2007 to 2012-13 mark, 2011-12. And there was a lot of aggression. which kind of died down towards the end of 2018-19, and again you had another, another round of aggression, largely because a lot of capital coming in, and the capital was valuing business with a multiple which is unique to India, which anywhere in the world people will laugh at, which is price to GWP. Now, price to GWP can never be a multiple to value insurance companies. But unfortunately, investors in India do. So whenever you see companies valued at price to GWP, obviously people will chase growth for at any cost. At which time you will pay whatever commission that you want to pay to the distributor for growth, which is obviously not a sustainable model. So you have to think about the three legs have to align in a manner that the stool on which you are sitting is stable.
Okay. So I was about to go to maybe segmental, but because you have raised a very pertinent point of again capital chasing the growth, and that's why I'm sort of bringing this question forward. I mean, over the last 5-7 years, there was some kind of, at least I would say, slow down in numbers of companies, or like a stable number, because I mean there were already, I would say, too many, or competition was. But again, we are seeing new licenses being applied for, new licenses are granted, and companies again entering. So at the juncture when we were hoping that, okay, at least, the capital providers are realizing that it is not easy to sort of generate return on capital in this business. It is not so easy, as you rightly say, that the multiples like price to GWP started to vanish. But again, we are seeing that some sort of so how do you see sort of a competitive landscape, say, over next 3-5 years?
I think we are seeing a lot of talk about new capacity or new entities coming in. I'm not really seeing any genuine, serious player coming in the next couple of years. What I mean by that is that, as I said, there's a lot of players who we all know are interested, applied, etc. But I don't see too many of them with deep pockets and with the right kind of investor base to compete in the market in the next couple of years. So let's look at the players who may come in. If, let's say, there is a global MNC which comes in with a 74% stake in an entity, I don't think we should worry about, because India is a very, very underpenetrated market. And if you look at, let's say, 32 companies in this market of this size and opportunity, it's not a big number. And I'm using that as an example because these typically are more responsible capital, right? They understand insurance and they want to build insurance in a sensible manner. I don't think we should worry about it. If we are seeing the similar type of capital that was coming in or was interested about 4 or 5 years back, which was, grow at any cost, I will fund you for 5-6 years and find the next buyer to take me out, I think that would be a cause for concern. But as of now, I think even that capital is beginning to realize that it's not very easy to create value in insurance through that model. So I'm, maybe a year back I was a bit more concerned about a lot more capital coming in, but right now I'm not as concerned. I think what has happened in the last 2 to 3 years is people have seen the implications. People have also made some calls on certain product segments, and when we get into products, we can talk about that. And I think people are beginning to realize that those calls may not have been a sensible call. So I'm not as concerned about, at least in the next couple of years, about too much of capital which is chasing growth at any cost coming into the market.
That's nice to hear that the market is going to show some discipline. You again brought a point regarding underpenetration, and particularly in the context of general insurance, it becomes very, very more imperative than life, because in context of life, you have competing savings and investment products. But here you are in the business of purely risk, that either, the risk is covered or it's not covered. Now, over the last 20 years, you have multiple sort of legs of growth. It started with motor, then came crop. Over the last 5-7 years, health has been the key driver. But one thing that has, still I would say a highly underpenetrated, that is what in the overseas market they call it home insurance. In Indian context, we have fire or like engineering, but it's largely a wholesale. In the retail context, home insurance, for earthquake, fires, or like theft, it's almost, barring mortgages, it's almost kind of a negligible. Now, what are the challenges? Particularly because our housing market is also not that organized. So what are the challenges you the industry has faced? And you, in this backdrop of what is happening, particularly the increased natural calamities, Do you see that, this home insurance can pick up or become meaningful over sort of a medium term? And if there is any sort of a policy tweak or support that government need to do?
I think that's a great question. And before I answer that, I'll just spend 2 minutes talking about or building on the point that you first made, that GI is very different from LI. We both have the moniker insurance, but honestly, I think our businesses are chalk and cheese. And I think the beauty of GI is the fact that in financial services, our space is not competed by any other player. So in life, there may be mutual fund, for savings, there's banking. For us, it's a pure risk business. And that's, I think, the uniqueness and the beauty of our business. To respond to your specific question, I think multiple reasons why it's not picked up. One is mindsets, and we used to see the same thing with health maybe about 10 years back. No one worried about needing a health insurance. Health insurance was massively a push product. Today, a lot has changed, right, in terms of awareness and understanding for the need for health insurance. The same is the story with home insurance. Today, the mindset is that, burglary, cat, it happens to you, not to me, so I don't worry about it. That's number one. Number two, I think as an industry, we have not designed products with the retail customer in mind. It's largely a cut paste of the corporate product, which is, tariff wording, standard terms and conditions, which is also changing now with the de-tariffication and the use and file regulation that has come in. In terms of policy support, so just to conclude the thought process, so I think the awareness is also changing. As you rightly said, there is a lot more awareness of catastrophes. The frequency of cats have increased, and people are now going to innovate on product category. So I think the home insurance piece will pick up. But can it pick up to the level that or will it pick up to the level that it can? The answer, in my sense, is no. It'll still maybe grow at 30-35%, but it's not reaching the opportunity or the potential that it has. And one policy support that we as an industry have been talking about is, everyone keeps talking about tax, etc. I think we should not expect that. It's very clear where the government is headed in terms of simplification of tax structures and exemptions. So I don't expect that, and I think it's correct, the direction that we are moving on the direct tax side. So one, other intervention that we've been seeking is that when an asset is insured, let's say for a banker, the underlying risk comes down. So one of the requests that the industry has made to our regulator, and I understand the regulator has taken it up with the banking regulator, is that there should be some kind of a capital relief if there's an insurance, for a home loan, for example. It's a fair ask, it's a reasonable ask, and it's good for everyone concerned. It will help the bankers, and it will help the insurance industry, and it will help the policy holder. If that happens, that will be a positive.
Right. So, you are hopeful that it will pick up, but still not at the level seen in the Western market.
It will take some time, yeah.
Okay. Now, moving on a bit to the regulatory and, governance developments. So one, of course, there has been a kind of planned overhaul of insurance bill. That is, right now it has not come in this session of Parliament, but there has been a lot of talk around at least the idea of composite. Now, if we were to look, around globally, composite is as a concept has not been that great in large market, at least markets comparable to our size. So, in Indian context, if this were to come, what's your thought on, the success of that composite insurer, and sort of a challenges for any new licensing coming as a composite insurer? And if that were to become a reality, how sort of it puts the general insurer versus life insurer, because there is a sort of a lot of talk around health insurance piece particularly, and the advantage life insurance companies have in terms of distribution.
Yeah, so I think that's a key point that you're making. I think we've trying to find a solution to a problem in a certain approach. Whether it's the best approach or not, time will tell. So the problem that we're trying to solve is that in the category of health, there is a clear demarcation between the non-life and the life segment. And since we've not found a solution that is up to the expectation of one stakeholder, so we are trying to find a new solution. Now let's go to the core issue. The core issue is that health insurance, indemnity health insurance, short-tail health, short-term products are the domain of the non-life companies and the SAHIs, and the long-term policies are the domain of the life companies. So till I think 2015, this wasn't the case. 2014, I think it was changed. 14 or 15, it was changed. Till that time, it was not the case. And at that point in time, also, if you see, almost 95% of the indemnity health was sold by the non-life companies. And I'll explain why, and I'll then hopefully answer your questions more specifically. So if you look at health indemnity, almost 50% of the business comes from group health, which is, I'm talking about the employer, policies, group Mediclaim or group health insurance, which is what corporates provide their employees. Now there, I don't think the retail distribution of life plays any role. It is largely an advantage of the GI companies because you are providing a bouquet of offerings to a corporate, fire, marine, liability, engineering, and also health. So there you don't have a real play, as a life company. The second part, which is the retail indemnity distribution, which is distributed through agency, I think there is obviously a distribution play. But that's largely been kind of taken away by the SAHIs because they have a regulatory arbitrage where they can just walk up to your agent and sign him up without having to license them. So the distribution is already happening. Whoever is interested in distributing health indemnity is already distributing it through SAHIs, may not be through the life companies. The other aspect of health, insurance is that beyond distribution, there are certain other core capabilities that you need, which is, unlike life insurance, the frequency of claims is much higher. You have to build capability on that service angle. You have the network management piece. You have the fraud, waste, and abuse, which is a very typical issue for health insurance, not just here, globally. So you have to build those capabilities. So just by unifying the two licenses, you may solve the distribution problem, but you don't necessarily solve this problem. Having said that, people may come together and maybe a life company will buy a SAHI. There are maybe 4 or 5 of them and come together and build this business, which is fine. I mean, I don't see an issue with that. Coming to your larger point on globally what we've seen, we know large markets, even companies which has both entities have kept it separate, right? Because, and there's a fundamental reason for it, because as we discussed, life insurance and GI is chalk and cheese, very, very different business, very different risks that you're managing, very different accounting principles, very different horizon of investment. All of those are very, very different. So even if you combine the two entities, I think the only thing that you're leveraging is the distribution. Rest of it, you have to manage the two pieces very, very differently. So it is possible that you'll get a life and health company as a combo entity. May not be as many life, health, GI going ahead, but we'll have to see. And honestly, at this point in time, I'm sure all of us are evaluating what is the best model for us. But this doesn't seem to be around the corner. So whenever that happens, we'll decide what's the best approach.
So one more question before we go to the audiences. Slightly more than 5 years post your listing, and of course, you were the largest private sector company, first one to get listed. So how do you sort of, now looking back, you find your last 5 years or post-listing journey, and being listed, was it some kind of, at any stage, any constraint that not being listed, you would have done certain thing in the last 6 years differently?
So yes, it's always easier to be an unlisted company in terms of operating freedom, right? There's no debating that. But I think the listing experience has been very, very positive for us. While I say this, I think it's been very positive because, one, I think it's built a lot more brand awareness for ICICI Lombard, and that helps in business. It's not just for investors, but even for our policyholders, I think that helps in our business. Secondly, I think all of you have kept us on our toes, and while even earlier we had investors who were very focused on how we were running the business, now we have hundreds of thousands of such investors, and you keep us on our toes, which makes us even more efficient. And that's at least we see that as a strength. As I said, of course, there are certain things that from a disclosure perspective, from approach perspective, some of the unlisted companies do things that we cannot do. Our strategy is, in a sense, is public. people watch our strategies and take action. So there are times that we are a bit more guarded about what we say. We would have been even more transparent if all these companies were listed. And that's the only thing that we kind of guard against, because people abuse the information asymmetry that is there.
Yeah.
So honestly speaking, the original act said that after 10 years, all companies should list. And in 2015, that was taken away. I think it's probably important to ensure that disclosures are exactly the same, even if companies are not listed. And in fact, one of the things that, if you remember, we said at the time of listing that reserved triangle disclosure is a vital thing, right? And we started disclosing in 2016 before listing. I'm so happy that now that's coming out. And you can watch people's numbers and figure out what we've been saying for the last 6 years.
Yeah. Thank you, Bhargav. Thank you. Now this sets sort of a context to take this discussion further. Now we shall open the floor for audience questions.
Hi. We look at, this is Miten here. We look at the retail health insurance market and how it's played out, and we sort of see one player running away with the retail market growth. And when we look at their claims ratio, they are almost repudiating 1 in 6 claims, and that doesn't seem to be impacting either their growth or their market share in a meaningful way. When you've assessed this market and you've sort of been measured about your approach to that market, what is it that crossed your mind, and the way you approach that market versus the way that player has approached that market?
I think the philosophy that we've had, not for health, but for every other product, is that if you want to build an institution for 100 years, your first priority has to be customer. You have to be customer centric. You have to really solve for customers' issues. And we have an internal joke, we've had an internal joke for even before we were listed, that we don't underwrite at the time of claims. And this is not for health, for anything else. So, and what that means is you don't underwrite at the time of claims, as in when the claim happens, that time you don't start figuring out what you should have done before, what terms and conditions to apply, and all of those issues to, reduce the claim. So with that mindset, when you look at launching products, we would never have a mindset of saying that, let me launch the cheapest product and I'll manage the claim. And that is a problem, that's a challenge. But because it's easy to sell cheap products, right? So our positioning as a company forever has been, we want to sell a product that is reasonably priced, but the moment of truth in insurance is claims. And at the time that you need a claim or you need us to be there, we are there, whole hog for you. As I said, at times it's challenging because it's easy to sell, cheap products in insurance. But our philosophy and our belief is, if you want to create a long-term institution, this is the best approach to build a business. You cannot follow the strategy that some companies have followed and hope that customers will stay loyal. I think the only issue that we have to grapple with, and by the way, this has worked for us for every category, including corporates. Corporate in India is very sensitive of price, but we've kept on gaining market share in corporate business in spite of the fact that we are never the cheapest player. So I think the approach works, is our belief. I think the real challenge that we've had with, particularly with Sahis, is the distribution disadvantage. Because, signing up an agent in insurance is non-trivial. You have to go out and meet 10 people, 2 of them agree to become an agent. You go through a testing and a certification process, training and certification process, 50% fail. So out of 10, you end up with 1 agent, of whom 30% become active. So it's a tremendous, effort and cost in building distribution. And that, when a competitor has an advantage of just signing up someone else's distributor, that is a real challenge. But be that as it may be, we also have other advantages, which is what we've been leveraging. And over the years, we've kind of, as you can see now, we are gaining market share in retail health. The one reason why we're particularly cautious till 2016 was because till that time the regulator did not allow repricing every year. And in health, with the 13-14% inflation that we see, if you're not allowed repricing, you run a risk of kind of either having a very expensive product at the get-go or having losses in the third year, which we had a problem with. So once that changed, we then went back into the retail indemnity market.
Fair. Thank you.
Hi, sir. Good evening. Has the company given any thought of procuring the composite business license?
So right now there is no point in debating that because Insurance Act has to change.
Okay.
It's anybody's guess when that will happen. So we are not holding our breath for that right now. We will have to also evaluate how they come up, what kind of construct they come up with, if it comes up with. First it has to come up with and then what construct. Within a group, will they allow multiple composite licenses? Will they allow 3 different types of entities? All of that we have to debate and decide. And accordingly, we will make up our mind. But I think the point that I was making to Avinash, finally, at the end of the day, these are very, very different businesses. You have to leverage certain advantages, let's say in terms of distribution. But there are certain other things that you have to really run very, very in a focused manner and in a manner that is relevant for that business. What happens for property, P&C, property and casualty, is very different from what happens in life and very different from what happens in health.
Thank you.
Hi, Bhargav. One question issue we've discussed earlier is inflation in the cost of healthcare in India. From your business perspective, I guess the annual repricing helps cover that to some extent. But how much is it a challenge for you as a business over the longer term to manage? Also, conversely, does it sort of perversely help the propensity to buy health insurance as inflation picks up, customer awareness about how, buying insurance help it? So I guess it works both sides, but how do you manage that challenge over the longer term?
I think that's a great question. And I think it's yes to both, but obviously you have to find the right balance. Healthcare inflation and the fact that you end up spending 7-8 lakhs if you go to a hospital in the big cities in India creates the awareness and the sense of need to buy insurance. But in the long term, if cost of healthcare keeps going up, the premium keeps going up, it will have an impact in terms of penetration. Because you can maybe touch the top 10-15% of the population, you can't go below that at one level. And the second, more social or more at a country level, the issue that you have to deal with is that we don't want, at least personally, I wouldn't want to see India go the US way, where let's say 19% of the GDP is in healthcare cost. I think that bears a tremendous cost, to the economy. So you have to find the right balance. I think there's a lot of work that is happening to find the middle ground. One, of course, the bottom 45-50% of the population, there is a model that has already been rolled out. Gradually, people will be more aware and, hopefully consume that insurance. The missing middle, there is a lot of work that is going on, largely encouraged by the policymakers, IRDA. As an industry, we are obviously keen to solve that problem. And we are aware that to crack that code, we have to find affordable cost of care, which is not really in our control. It's something that we have to do as a partnership model with healthcare providers. Lastly, even for the top 10-15%, this kind of inflation is not great. And I think there's a possibility. There's a lot of work going on in terms of with the blessings of the regulator, in terms of the industry to come together and at least control the fraud, waste and abuse that is happening, which can be defended by no one. And that's one journey that some work is happening. There's some work happening on building a health claim exchange so that transactions are digital and at least that cost of service comes down. And once it is digital, then you can also run a lot more analytics around some of the issues that is happening. IIB has started coming out with some data, cross-industry data, cross-company data on fraud, which I think has really helped the banking industry, the credit bureaus. Similar thought on the insurance side. So rather than say that, cost has to be capped at this level, we are trying to focus on the fraud, waste and abuse, and through that process reduce the inflation of insurance.
Hi, good evening. With the new regulations with regard to commission and expense management by the regulator, right? Like, what kind of impact do you see, A, on, on Lombard, and B, on the industry as a whole? Thank you.
So, if you see global benchmarks, in no developed markets do you even see expense of management for GI. It may make sense for savings products, but not for GI. In India, we had expense of management, we had sublimits of commission. Within each product, we had further sublimits of, which was almost impossible for anyone to manage. So to that extent, this really eases up our operations. Purely from a ease of, doing business, it's great. But even this, if you look at global benchmarking, if you talk to, let's say, the global analysts, or if you talk to a global rating agency, they'll be surprised to hear what is this EOM, right? As I said, let it be for the time being. But EOM actually really helps us, not just from operations perspective, but what the regulator has said, that anyone who is more than 30% or more than 35% for a SAHI should have a glide path, or has a glide path of bringing it under control in the next 3 years. And we've seen almost 2/3 of the companies are above that limit. So if that happens, if they actually bring it down, so it depends on how much the regulator enforces the new regulation that they've put in, and we have to watch for that. I think the first quarter numbers for all companies will be out, and then we'll see what the EOM numbers are for them, and then we'll see what the regulator does. If that happens, I think it will help companies which are lower than 30 EOM or lower than 35 EOM. From our perspective, we have cushion, but that doesn't mean that we unnecessarily increase our spends, simply because the pressure to increase spends will come down if others are also bringing it down. And secondly, we obviously have an objective of combined ratio, so that's something that we want to manage. So in the long term, the sense that we have is that the regulator is very keen to reduce the overall distribution cost for the sector without bringing in some kind of a regulatory mandate saying that this is it. So they're doing it, in my opinion, the right way, setting an overall framework and nudging the industry to reduce the distribution cost. And initially 30%, but we'll see if it comes down. We will see how others what they do there at the next level. Lastly, I think companies with multiple lines of businesses, we have an advantage because we can kind of manage the book across different lines of business in terms of the limits that we have across different lines. Plus, scale advantage definitely is something that we have. So, all in all, we are very, very, this has been an ask for the industry for a long, long time. So we are very happy this has come. Or from an ease of doing business perspective, as also the flexibility in managing our business in a meaningful manner. And hopefully in the longer term, the distribution cost comes down.
So we have seen in our business, the broking business, technology leveraged and commission rates have continuously kept on going down. Now similarly, have you been able to leverage on technologies whereby the premiums that you collect, say on motor insurance for example, have you been able to gather more data, etc., and ensure that for the same capital value, what premiums or insurance premiums you were charging, say 10 years ago, has it come down, or have you made that effort, or something like that has happened?
If you take a long view, and let's take 2008 to 2023, 15 years long view, right? You'll see that insurance, the inflation is actually, it's probably been deflationary in certain product ranges. So all PNC ranges, prices lower today than what it is in 2008. Largely driven by competition, but I'll give you, let's say, another data point for you to consume. So ICICI Lombard, let's say in 2008, we were writing about 3.2 million policies at that year. Last year, we wrote 32 million policies, about 10x, right? If you compound on a CAGR of 16%. If you look at our GWP growth, in the same period, it's about 13.5% GWP growth. So obviously, the business has got more granularized. That's what has happened for us. If you look at our head count, all our employee plus all the FTs, for example, staff who's kind of outsourced staff who worked for us, that number is down by about 25% from that time, down by 25%. If you look at our profit CAGR in this period, it's about 20% profit CAGR. So top line CAGR of 13%, profit CAGR of 20%. In an industry where from 2008 to 2023, industry profit have actually come down. For industry profit has been lower in 2023 than what it was in 2008. So the answer is obviously yes. All of this is because of technology. Now, maybe till about 2017, the focus was in automation, cost reduction, convenience, drive digitization of policies. We reached about 97% of our policies, we don't see paper today. So that was till 2016-17. Since then, the focus has been in terms of, AI, ML, analytics, better propensity models. So that's what we've been doing. So I would say the last 4 or 5 years, a lot of work has happened on that area, particularly in the area of fraud, underwriting, claims processing, where we're using a lot of these machine learning models to make it even more effective, not just efficient, but also more effective in terms of the quality of decisions that we're taking. So the answer is absolutely yes. Significant reduction in cost of service, as also ticket size and premium per policy over these years. In spite of that, we've had a pretty decent run in terms of profit CAGR.
Thank you.
So, are there any big untapped segments in GI which you see in other parts of the world, which probably has not come to India, and you think that there is a scope for that to happen?
So there are untapped segments, for example, home, Avinash talked about. So if you look at the number of Pakka houses in India and look at even a 10,000 rupee policy, that's a 60 to 70,000 crore market. Even if you get to 20% of penetration, you're talking about another 15,000 crore market. So there's a massive opportunity in new areas. But forget new areas. If you look at motor insurance, we've talked about this. 50% of the motor vehicles in this country, drive without insurance. SME penetration about single digit, 4 to 5%. Large corporates, they under insurance. So every time there's a claim, we evaluate and we realize that whatever is the sum insured, they've not taken full sum insured. So under insurance. Or business interruption policies. Very common everywhere in the world. Indian corporates don't take it, except for some corporates. Non-damage BI, no one takes in India. So even in existing categories, health, we are still talking about top 10% of the population who has a proper health insurance. So, by the way, in health, we are only talking about IPD, hospitalization, which is largely about 33% of the total healthcare spends. 65%, which is outpatient, not covered. Everywhere in the world, it's covered, right? So, in existing categories, there is a massive amount of, coverage gap that still exists. In terms of policy or in terms of adequacy of cover that people buy. And then there are these new, areas that we are talking about, or not new, but areas where in other markets we see significant penetration. So our sense is that, and you see the numbers, right? Our insurance density is 1/10 of China. Forget US or forget Europe. They're like, a few hundred times more. So I think there's a massive under-penetration. India will never go to those levels, of course. We are a different market. But even to reach, let's say Chinese numbers, we have a long path of growth for ourselves.
So when it comes to home insurance, is it that the consumers assume that the odds of something going wrong are infinitely small, which is why they don't take out insurance, or is it the cost of insuring it? And which is why you want to tweak in regulatory policies?
So I think there is also, let's say, motor insurance, right? I think people think that they can get away with breaking the law. In India, that's always the worry that, deterrence is very poor. Also, they may think that, my two-wheeler, 3-4-year-old, kuch hoga to bhi, I'll get it repaired on the roadside. Doesn't matter, I'll manage it. Accident is not that frequent. In home, as we discussed, कौन देखा है fire, कौन देखा है burglary, कौन देखा है और आपके साथ होगा, मेरे साथ नहीं होगा. So that's a mindset issue, which is changing. I mean, the same mindset we saw in health 10 years back, that's changing. So, and if you see global studies, Sigma does a Swiss body called, they have a body called Sigma. They have the Sigma report. They show data across economies where the GI penetration curve is a S-shaped curve, which picks up at $2,000 to $2,500 per capita, then goes up like this and then flattens at, I think, about $10,000 per capita. So we are at that cusp. It has to happen because, when an economy grows, first you think about savings, then you think about investment, then you think of assets, buying homes, buying, two-wheelers, then you think about, protecting those. It's a natural progression. If you look at all other financial services categories, GI, in a sense, comes last in terms of priority.
And last question. So you got this Berkshire Hathaway which does this super cat, which is writing against earthquake and falling indices 10 years out. Will that part always be an entrepreneurial setup, or can those kind of insurance get institutionalized?
No, it's, if you look at the players writing some of those exposures, include some of the big global reinsurers, right? I mean, these are institutional players. I mean, Munich Re or even Berkshire, they're not they're now institutions.
So it's a reinsurance market.
It's a reinsurance market because you need very, very deep pockets to write those exposures and retain it on your net. And you need to have diversification across the globe. You cannot write those kind of exposures in India because 1 year, I mean, sitting in India, writing for India, it's a massive risk. So for us, it makes more sense to protect our balance sheet, taking those cat reinsurance, for example, so that massive events happen, we don't have a big hit. So, for example, last 2 quarters, there's been cats in India, right? It will have some impact, couple of percentage point in our combined, but it's not going to blow our balance sheet by any stretch of imagination.
Thank you.
So 2 questions I have clubbed because I was expecting that to come from audiences. That one, in a market where the players are obsessed with growth and customers are very, very price sensitive, and that is what sort of gives rise to, I would say, a bit of a predatory B2C brokers under different names. You have been someone who sort of stayed away from this in a kind of a commoditized market. So, I mean, if you can just sort of explain what's your thought process behind this, I mean, in a growth obsessed competition and, a value conscious customer, how did you sort of executed your thought process behind staying away from this? So that's one. And added to that, because you were talking about a motor, I mean, in India, of course, the prices have come down, but the prices are still, particularly for you, the cost is high because the claims management or claims servicing is done largely by the OEM-led garages, and it's a kind of a no secret, the kind of cost, the inflated bill that comes. Do you see sort of a solution of that problem in near future?
The second one, if you have to find a solution, there would be some amount of intervention by the regulator. Otherwise, it may be very difficult to find a solution. But there's, you can never say no. It's highly possible that something like that will happen. The second thing there on motor is that, for example, for us, the percentage of digital and our agency channel source business is increasing day by day. And there, let's say when we started our PPN journey, PPN is Preferred Payment Network garages, where we divert our customers to those garages. We provide service guarantee, we provide claims experience guarantee, parts, etc. All of that we provide, and we still see some savings. That percentage has been increasing year on year. So now it's in the mid 60s. In certain months we reach even higher numbers. So all of that actually brings down the cost of claim. And if you see, I think the first quarter, some of the numbers that we talked about, some of these things are playing out. But purely OEM sourced, OEM service, the point that you're making is valid. But usually in these things, as the systemic pressure one day comes in, and these things get moderated. My sense is it will happen even in India. I can't predict when. your larger question of managing for a balance, you see, at least our view is that at the end of the day, for a large brand which positions itself on service, competing on price on a digital platform doesn't make sense, number one. Number two, you don't own the customer. There's a lot of churn with those customers. It made much more sense to build or spend the same amount of money building your own D2C model, which your own channel. And we invested that for our digital business, our website, as also our mobile app, right? And if you've seen the impact that we've had on the mobile app, it's really 3-4 years. It's a new mobile app. Earlier, the app was a sales app. 2019, we launched our service app. That's doing, in our opinion, brilliantly well. And month on month, we are seeing superb traction. So we would rather spend the money as a big brand. I mean, if you were a small brand, I would have been there. But as a big brand, it makes more sense to build your direct connect with customers. And lastly, chasing growth at the cost of profits, we've never done that. And I think we've done okay. As I said, at the end of the day, finally, it's not only top line growth that matters, it's also bottom line growth. And I gave the numbers for the last 15 years, 20% CAGR in terms of profits. Back in 2008, we probably made 100 crores of profit. Last year, we made 1,700 crores of profits.
Thank you. We can take one more audience question or
Yeah, hi sir. So the IRDA has come up with the implementation of IFRS possibly from FY25. So what kind of impact is it expected to have on the industry as?
So multiple levels. I think exact model will be decided as we go along, but there would be impact both on the asset side as also on the liability side. On the investment side, there would be impact on mark to market and how we account for it. On the liability side, there will be a huge impact potentially. Let me explain this in 2 minutes so that you get the grasp of what we are talking about. So in India, the third party claim duration is very long, right? So on an average, it's about 6 years by our estimate. We hold a reserve which is on a nominally inflated basis. So if it's a 100,000 rupee claim today, if you think it's a 12% inflation, then we hold 200,000 rupees on that reserve because it will be paid 6 years later. Now, globally or under IFRS, that should be discounted by risk-free rate and brought into present value. In which case we should be holding, let's say, about 140,000. So that means 60,000 rupees will be released. And in fact, this quarter we put out the number in terms of what happens to a combined ratio as a company if we followed IFRS only on this account, because everything else is not finalized. So our combined ratio improves by about 4% if you follow global standards and that's why we've always been saying that Indian combined ratio is not comparable with the combined ratio elsewhere. Now, what happens at that point in time in terms of whether this one-time upside for the industry, is it going to be parked in the balance sheet? Will it flow through the P&L? All of those are issues that will be addressed. But I think a lot more comparability of accounting will happen. You'll be able to benchmark numbers vis-a-vis other markets. Companies which are holding low inflation, let's say in that example that I gave of 12% inflation, if I'm holding 5% inflation, I may have a problem. And some companies we believe do hold very low inflation numbers. So those things, I think there'll be a lot greater comparability and transparency.
With this, we should close this session. Thank you, Bhargav. Thank you a lot. That was, a very insightful talk and definitely provided a lot about, a lot of understanding about the past and probably the future of the sector.
Thank you. Thank you for having me, Avinash. Thank you.